That sell-off in the bond market has made the beginning of 2022 one of the most volatile starts to any year in a long time. Bond investors are being whiplashed as central banks move to cut extraordinary stimulus across developed economies. In Australia, investors are betting that the central bank will follow the Fed in raising rates, despite expectations that inflation is likely to be well below the elevated U.S. levels. For more, Kelvin Tay, a Regional Chief Investment Officer at UBS, joins us. Well, Kelvin, here in APAC, which emerging markets fall under that category that would take a big hit from more Fed rate hikes?
I think any economy that has a lot of debt denominated in the US dollar will probably be lumped under that category, largely because if the 10-year US Treasury yields are at about 1.8%, then obviously the government bond yields in this part of the world will have to rise in tandem, because if not, then investors are not going to put their money into this part of the world. So if your bond yields are rising, that basically means that you are borrowing at a higher cost. And if you're borrowing at a higher cost, that in turn basically means that you have to pay more in interest rates, right, on a per annum basis. So if you're using more of your revenue to actually pay for your interest, then that means that you have less money available for your reinvestment, for your capital expenditure, for development. And that in turn is actually not good for the markets. It's not good for the economy because it tends to slow the economy down. So any economy in Asia that has a lot of debt as a percentage of the GDP will basically fall into that category.
So then how can they prepare their economies and their people for such a scenario?
I think most of Asia is fine because of the fact that most of Asia doesn't have a lot of debt. I think the only two economies that have quite a significant amount of debt as a percentage of the GDP is basically Malaysia and India. And these two are probably most vulnerable from that perspective. So what they need to do is that they need to actually tighten their fiscal belts. And in turn, they also need to actually increase the interest rates to a certain extent to prevent an outsized outflow of their local currencies out of capital out of their economies itself, because that in turn is likely to actually result in further higher inflation and a depreciation of the currency, which means that it will be very difficult to actually find investors willing to actually invest in the economy.
Kelvin, turning now to rising bond yields, how should investors position their portfolios this year?
Yeah. Well, I think it's not just the rising bond yields. I think we need to be aware of the fact that this year we'll probably see the Federal Reserve actually embark on a normalization of the balance sheet. Now, since COVID-19 happened, the Federal Reserve has actually been printing or doing QE, as we call it, quantitative easing. And the size of the balance sheet has actually doubled to about 8.5 trillion compared to the 4.2 to 4.3 trillion before the pandemic itself. Now, this is where it becomes tricky. The Federal Reserve's policy meeting minutes last week revealed that the committee members are actually talking about an earlier and also a shrinking of the balance sheet at a faster pace, at a greater magnitude than what was actually originally thought. Now, if that's the pace, that is likely to actually send the bond yields rising even further. And that, in turn, is likely to actually spook the markets. Now, in terms of your asset allocation, we do think that the tech sector is probably vulnerable. In particular, loss-making tech companies that have not turned a profit that are listed. Those are likely to be most vulnerable. On the other hand, the rising bond yields and the steepening yield curve is going to be very positive for the US financials because of the fact that their net interest margins are actually expanding. So that's how you should actually allocate your portfolios. On the bond side, you probably want to be invested in credits that are actually pegged to a floating rate. Like, for example, your senior loans, your private credits, and your floating rate notes. And you don't want to be in anything that has actually got a fixed interest rate, because of that in turn is likely to mean that you are actually going to be seeing losses from a mark-to-market perspective.
Yeah, Kelvin, so just a little bit more about what about tech and property sectors that are more sensitive to those higher borrowing costs?
Yeah. When economies are slowing down and, when interest rates rise, economies will eventually have to slow down. That in turn basically means that the sectors that you want to be in is basically healthcare. Now, healthcare throughout its in the last 10 to 15 years has always done well when ISMs are slowing down, when your PMIs are slowing down. That basically means that you're basically at the last stage of growth. So we do think that healthcare investments would be ideal for this stage of the economy. On top of that, we do like the cyclical stocks, the value stocks, like, for example, the energy sector. We think that oil prices will continue to remain very resilient because of the fact that your energy prices right now, your energy stocks right now are pricing in an energy price on oil price of about $56 to $60 per barrel. So that means that there is some way to go before the oil stocks actually catch up with the current level of oil price. On top of that, we think that you need to be careful where your gold is concerned, because when you have the real yields rising, which means your US Treasury yields minus inflation, when your real yields are rising, that in turn has always been pretty negative for the gold price, right? So we do think that gold prices are likely to be quite weak in the next 6 to 12 months. So with that in mind, we do think that in terms of your asset allocation, you need to be overweight in equities, maybe with 55 to 60% of your investment portfolios in equities and 35 to 40% in the credits that I've been talking about. Last but not least, Asian high yield is particularly attractive on a risk-return basis because of the fact that your Asian high yield index is yielding at about 8.5% to 9% right now, and we do think that the worst is over with regards to the Chinese market.
Kelvin, if I may just squeeze in one more question. Are markets pricing in tighter monetary conditions in Asia?
Not yet, but I think markets will eventually have to do that because of the fact that most of this region, their biggest trading partner is the US. So markets might actually have to do that to actually account for higher inflation as well. But the gradient of the increase in interest rates is not going to be as sharp as what's been happening or what's happening in the US, right? You get this basically asynchronized recovery. In Asia itself, most of developing Asia is still struggling to recover from the COVID-19 pandemic. And therefore, we are in a pretty much different part of the cycle compared to the US. So I don't think the markets here will have to tighten as much as the US. Last but not least, a weaker Asian currency has always been pretty positive for exports as well. So I don't think the central banks in this region are likely to tighten dramatically unless inflation is a problem in the local economies. And across the board, inflation has not been a problem, right? Whether it's China or Singapore. In Singapore, we do have a bit of that problem, but it's not as dramatic as what we're seeing in the US, which is basically at full employment at this level. So a weakening Asian currency is good for our exports, but we do think that sometime in the next 12 months, perhaps the Asian economies might have to tighten as well.
All right, thank you so much for that. Kelvin Tay from UBS.